Stephen Hester, how do you sum up RSA's performance in 2018?
The 2018 results that we have just released show, I think, a respectable performance with quite a lot of things going well, but also a performance that we can improve upon. In fact, we should improve upon. At a headline level, we've got pre-tax profits up 7%, we've got dividends up 7%, our return on capital is something like 13%, which is well above our cost of capital. So all of those are good things and supported by many activities in the group that went well. But our underwriting profits were down for the year. In fact, it's our first down year in the last 5, and we need to put that right. It was partly about bad weather, partly about difficult conditions in commercial lines. We've announced a whole bunch of actions that I'm confident will fix the issues to the extent you can fix things. Of course, there's always some volatility. So we will do better, but off the back of, I think, a respectable performance.
Your investor presentation highlighted that the personal lines businesses delivered a healthy combined ratio and good growth this year. What's been driving that, and can you maintain it?
Our businesses that serve personal customers, our personal lines businesses, account for, I don't know, about 60% of the group. So, of course, in that sense, they drive our group's fortunes. And last year, we put in an excellent performance. The businesses grew roughly 5% on a global basis and put in very strong profitability, a combined ratio of just over 92%. So we're really happy with that. I would say it was a tough weather year, particularly in Canada and also in the UK. Cold winter and actually too warm summer with subsidence and so on. And so the results were a couple of points worse than the year before due to weather. But fundamentally, I think our personal lines businesses are in good shape. There are many things we can do to improve them, and I believe they will continue to drive the group this year and into the future.
So that's personal lines business, but on the other hand, commercial lines underperformed for RSA. And that's something that we're seeing with many of your competitors. Is it a markets thing? And what's your strategy there?
Our commercial lines results, which is about 40% of our group, last year were frankly poor. And we made a loss in that area. Not, of course, in every bit, but in the total. That was driven in large part by external market conditions. Of course, it was something like the 4th year on record of bad hurricanes, the 4th worst year ever. And also there were tough conditions in wholesale markets, which have affected most, if not all, players. But even taking that into account, which would have given us a tough year, I think there were some things that we were more exposed to than perhaps we should have done, and some things we could have done better. So our commercial lines businesses, we've announced some significant exits in the most internationally exposed of those, what we call our London market business. We've announced some major pricing and underwriting changes, and we've tightened up our reinsurance as well as made management changes. And I think that that package of measures we will see in 2019 give us a significant bounce back in the commercial lines businesses, and I'm confident that they can perform well in the future. But it's certainly the area that 2018 was not something that we could be proud of.
Your shareholders will be pleased that you've increased the dividend again. You've reported strong capital position and new UK pension settlement. Talk us through that.
Well, for all financial institutions, of course, capital and financial strength is vital. And so yet again, for the 5th year running, we've improved our capital position. Our Solvency II ratio at 170% has hit a new record high. And beneath that, we've reached a new pension settlement for our UK pension schemes. Contributions will stay broadly similar to before, something like £75 million a year. But the scheme should be set for the long term in terms of a path to complete de-risking. And the scheme, in fact, has moved into surplus in the last year. Now, dividends are, of course, a vital expression for our shareholders of our success, but they are no more than that, by which I mean we have to make profits from which to pay dividends. Because we've done much better in recent years, the dividends are rising. I believe that our performance can continue to improve, and that will allow us to pay good dividends and also possibly from time to time some additional distribution, stock buybacks or whatever. And so we know that it's a symbol of our success. We know we, first of all, have to produce higher profits. I think we can do that, and then that allows us to distribute to our customers, to our shareholders, and to all of our other stakeholders the fruits of that financially and in terms of service.
Now, something like 3/4 of RSA's business is outside the UK. How do they fit into your best-in-class ambitions?
Well, of course, at a time when people are maybe overly focused on Brexit and the uncertainties that that brings, particularly for UK-based companies, I think it is a great strength of RSA, as you say, that something like 75% of our business sits outside the UK and therefore benefits from conditions in a number of different regions. And those are our highest performing businesses. So I would say every one of our international regions either is performing at best-in-class levels or has the capability to within the next 1 or 2 years. And so we're very proud of the improvements that we've made. Scandinavia is our flagship area. Something like half the company's value sits there. Canada, tough year last year, but I think we can bounce back very well. And we had some super results in Ireland and the Middle East as well. So our international businesses are a source of great strength for RSA, and I think are in good shape, but with many things that we can do better even there.
Let's talk about the UK. UK performance disappointed for a second year running. Now, you've made management changes, you've exited some portfolios. Can we expect recovery next year?
Our UK business is a very important one to us, but it's one which we have struggled to get the same level of success that we've been able to achieve with our international businesses. Now, when we say UK, in fact, something like a quarter of what we badge as the UK is international business written through the London market. And that's really in the last 2 years where we, and I would say most other participants, have had tough conditions. And that's why we've announced major restructuring and major reduction in the scale of our participation in those London markets. Our domestic UK business, in fact, has been profitable, was profitable last year, I believe will be going forward. But even there, it's a big market, it's a very competitive market, and we're needing to invest to really transform our cost base, to transform our digital capabilities, especially for personal lines, and the cost and the time involved in that is limiting our profitability in domestic UK below that we had hoped. We've made a management change. We've made actually a number of management changes. I believe that we can succeed in the UK, and I think that we're taking the right actions to make that happen.
You've now been at RSA for 5 years. Looking back, what's been achieved and what's still on your to-do list?
You know, RSA has been around for 300 years, and so in that sense, any short period of time, even 5 years, is going to be irrelevant in this sweep of history of RSA. We've been an important insurer for a long time, and we will be, I believe, for many years to come. But I think it's nevertheless fair to say in the last 5 years, we have accomplished a pretty significant overhaul. We've fundamentally improved the competitiveness of the company, so something like a 7 or 8 point improvement in combined ratio from much lower costs, from a much better attritional loss ratio standpoint. These are fundamental improvements which mean the company is set up to perform more consistently and at a higher level than for many, many years. What we have not yet done is turn that competitiveness, those fundamental improvements, into the high level of performance, what we aspire for, the best-in-class levels of performance. And so the job for the next 1, 2, 3, however many years, the job for the years ahead of us is to turn the foundations we built into a shiny house, a best-in-class house, and very, very good performance for our customers, of course, and for our shareholders.
Stephen Hester, thank you.
Thank you.